And so when it comes to OneMain Financial and the compounder curve, where would they fall? How's it going, friends and family? My name is Amos. In today's video, we're going to be analyzing OneMain Holdings, otherwise known as OneMain Financial. And if we jump on over to the dividends tab, they have got a massive dividend yield, 7.8%. If we round up 8%, payout ratio is 64%. However, they have a business model that makes most investors feel uncomfortable. So the real question, is it a high yield compounder or is it a yield trap? So what exactly is OneMain Financial's business model and how do they make revenue? So it's a consumer-focused financial company that serves customers that have less than ideal credit scores. And their core offerings are personal loans in the ranges of like $1,500 up to about $20,000 and credit cards that are typically targeting these customers that have credit scores around 590 up to 630, 640. And the interest rates are absolutely absurd. It's roughly 18 to 36%. And the company also generates revenue through life and disability insurance products, as well as auto financing. So it's kind of like a one-stop shop. And in many ways, the business reminds me of Main Street Capital, except OneMain Financial, it's B2C lending, and they pay a qualified dividend, which is way better for taxes. And as we hop on over to the recent developments surrounding the company, based on their most recent earnings and management's 2026 guidance, we know that the rate of delinquencies, people that are late by more than 30 days on their payments, it's going to be 5.9%. And they expect to experience 7.7% net charge-offs, in other words, money that they will never get back from their customers. That means for every $100 that they lend out to customers, they're going to lose about $7.70. But they actually come out ahead because they charge a very ridiculously high interest rate, 20 to 30%. So if you meet in the middle and say 25%, so from that initial $100, it'll turn into $125. And if you minus the $7.70 from the net charge-offs, then they walk away with $117.30. Otherwise, $17.30 in profits. Not bad. And as we transition into the cheese situation, what are the three big considerations when it comes to OneMain Financial? Number one, I have bank in disguise. And that's because when a bank says no to a customer because of their atrocious credit history, OneMain Financial, they'll say yes. So to me, in my interpretation and my understanding of their business model, it's basically a bank. And not only that, they have about 1,300 physical locations across 48 different states, handling money lending services. So it's kind of like a bank, right? Between you and me, having the overhead costs associated with running a brick and mortar financial firm, I think it's good and bad. However, I would skew towards the good bucket because in the world of money and loans, it helps to build customer relationships. And the second bullet point, collateralized. It's not risk-free loans that they're handing out to the customers. They typically secure the loans with collateral, such as the customer's card if they're doing auto financing. So if the customer stops paying their loans every month, then OneMain Financial, they'll come and seize their vehicle and sell it off and try to recoup some of their losses. And the third bullet point is interest cap, because there's pending regulatory caps on credit card interest, and that could be a big blow to their margins. And that's one of their big pushes right now and their growth drivers, because the whole idea is to keep the customer in their ecosystem instead of going to Bank of America, Wells Fargo, or even SoFi. And I think a very valid question is, why the heck would someone use their services when the interest rates are 18 to 36%? Well, more often than not, it's because the customer, they do not have any other options. And they need to build their FICO credit score. That way in the future, if they want to take out a mortgage, a loan, or whatever else have you, then they can do so at a more favorable rate. But everybody has to start somewhere, especially if you declare for bankruptcy or if you're trying to just build your credit, which between you and me, I started to build my credit to Discover Finance. And funny enough, my marketing teacher in high school, she told me to just open up a credit card and buy a stick of gum every month for like 50 cents, pay it off, and eventually your credit score will go up. Well, you fast forward like 20 years later, and my credit score fluctuates between like an 850 to an 870 depending on the month. Changing gears a bit, let's talk about the report card, their financials and numbers. The first one is their financial performance. It's based on their P&L, their margins, the consistency of their revenue, their net income, or in this case, their net interest income, and share buybacks. I would argue their net interest income trend is very strong. Their return on equity is 23.7%. That's really beautiful. For this company, the golden standard, about 20%. They exceed that and then some. And they've been buying back the shares since 2019. However, their bottom line, it tends to fluctuate and it goes in cycles of highs and lows depending on the credit market. So overall, I would give it a B. And when it comes to their balance sheet for a money lending business, it's just okay. It's not great. It's also not terrible. By nature of their business model, they're highly leveraged, but it's balanced by their liquidity. So I would say a C+. And in terms of the dividend profile, the dividend safety, up until 2021, they used to pay a special dividend like Costco or Progressive Insurance because they have excess capital going into their pockets and their name in the game is rewarding the share owners. To be honest with you, I love it because the whole point of investing is the ROI, your return on investment. You don't just put your money into a stock for charity or as a donation. And a company can return profits back to the share owners in many different levers they can pull, right? Share buybacks, dividends, expanding their business and growing their margins and their top line, bottom line, and then their share price moves up. My personal favorite is the dividends, obviously. But what I'm really not a fan of is their dividend growth rate is 0.5%. It's barely growing. I mean, it went from $1.04 every quarter. Now it's $1.05. If we scroll down and take a look at their special dividends that were paid out during the pandemic, massive, right? Almost $4. And then their regular dividend payout was 70 cents and then $4.20. But as you can see, they're no longer issuing a special dividend. That's because they need the extra capital to offset the amount of people that default on their credit, on their loans, and that's the net charge-offs, and that's going to be around 7.7 to like 7.9%. And as I was doing my research for this company, I was reading their 10Ks for the past 5 years, and they said that during the pandemic, because of the stimulus checks of $2,000, they barely experienced any net charge-offs, and so they were profitable beyond belief. However, that's no longer the case. Having said that, all things considered, I think their dividend safety is an A. I do not see it being cut anytime soon. And when it comes to their valuation, OneMain Financial is fundamentally a balance sheet business, right? Because their primary assets are the loans that they hand out to people, and they're highly leveraged as a result, which means the traditional PE ratio, it's not my first choice when evaluating this company. Likewise, when it comes to a BDC, a business development company like Main Street Capital or Ares Capital, you shouldn't be looking at the PE ratio. So instead, valuation boils down to one question. What are those loans actually worth after losses? And that's exactly what the tangible book value measures. And as of right now, at the time of making this video, OneMain Financial, they're trading at about 3.8 times the tangible book value, which is, between you and me, that's a huge fat premium, and it suggests that the stock as of right now, they're priced close to perfection. I think a really good comparison would be like Palantir having a PE ratio of like a 200, 250. If you mess up at all, the stock market will punish you very harshly. Historically, you'd typically want to see that number closer to like a 1, maybe up to around a 1.8 during strong credit environments, the tangible book value per share ratio. To see it at a 3.8, right? So in comparison to their own timeline, it's trading for a very high valuation right now. I do not think they're cheap based on that valuation alone. So I would say the grade is going to be a C, just okay. Now, having said all of that, what is the intrinsic valuation, otherwise referred to as the inherent worth on this channel, based on their own fundamentals, financials, and their trajectory in their future? Well, based on the GARP formula, which is something that I created, it's available on the Patreon if you want to plug and chug a stock of your choice. It spit out a valuation of $67.27, predicated upon their net interest income growing by 4% year over year. However, if we were to adjust the numbers and say their net interest income were to grow by 6% year over year going into the future, then the GARP formula says OneMain Financial is $81.38. And moving on to the second inherent worth calculation based on their peers and how the market values them, then OneMain Financial should be $79.32. And last but not least, based on their dividend profile, the dividend discount model, it says they should be valued at about $69.54. Which brings me to the valuation gap. So as of right now, they're roughly like $53.70, $53.80, depending on when you watch this. If we round up and say they're $54, their inherent worth price is about $72. We could even minus $2 and say $70, or add a little bit and say 75, around $72. So the valuation gap from their current price point to reach what they should be on paper is 33% into the green. And so baking in a margin of safety, looking at their technical analysis indicators, and with a dollar cost averaging framework, I think a good price to open up a position, like a small amount, like if I had $100, I would allocate maybe 10% at roughly $52.29. And then the bargain price to buy into OneMain Financial, about 25% of the capital using that dollar cost average logic at about $40 a share. However, if OneMain Financial were to reach $33 a share, that's when I would back up the truck and load aggressively and go all out if I were in love with this company. I'm not trying to tell anyone what to do with your money. I'm just telling you hypothetically what I would do on paper based on the numbers that make sense. So the steal of a price would be at $33 a share. And so when it comes to OneMain Financial and the compounder curve, where would they fall? Well, friends and family, I think on paper, OneMain Financial, it's a solid business that's posting above average fundamentals, especially when you take into account their CAGR. And what I mean by that is the blue line represents OneMain Financial, VU, obviously the S&P 500. If we zoom back and say 5 years, then S&P 500 comes out ahead. However, if we were to back it up and look at it from a bird's eye view for both of them, maximum timeline, then OneMain Financial is 511% when you bake in the share price appreciation plus the dividends paid out, whereas the S&P 500, represented by VU, we could plug and chug SPY as well. It'd be exactly the same number, plus or minus like 0.01%, 396%. So if you break that down on an annualized basis, the compound annual growth rate, then friends and family, for OneMain Financial, that's 15.8%. That's pretty good. In comparison, the S&P 500, 14.4%. So their performance in the stock market, shockingly, I did not expect this prior to doing research and an analysis on them. I'm pretty impressed because based on their business profile and their peers, I thought they were going to slightly underperform the market, but that's just not the case. Even 10 years back, 16.9%, in comparison, roughly 15%. But in just the past 5 years, then the S&P 500 is superior in comparison to them. And that's because the S&P 500 has representation from NVIDIA, Microsoft, Google, Amazon, the Mag 7, whereas OneMain Financial, they do not. And so that kind of complicates matters. Because initially going into this, I thought it would be a really good income payer for someone that's retired, right? Now, this might sound crazy, but OneMain Financial, it could be ideal for investors that want that high yield of like 7, 8, potentially 9% if they're willing to accept some volatility in share price appreciation, because there are some violent swings depending on the credit market cycle, but also the outlook of the economy. Because obviously there's going to be a lot more defaults on loans and credits, especially from non-prime customers, right? If your credit score is like 570, 540, think about your priorities of order. Right? I think number one, they're going to pay their rent or mortgage in front of everything else. Number two, potentially the groceries. Number three, utilities, their phone line bills, internet, stuff like that. I feel like all the way at the bottom would be their personal loans, right? And so if that's last to be paid and they run out of funds, that's what a customer with like a 550 or 570 credit score would default on first. Just my thinking. So that's why the market bakes that in, that risk, and that's why their share price has violent swings. Case in point, if we only take into account their share price and we zoom back their maximum timeline, you can see 166% total return only for the share price appreciation. But because they pay a ridiculously high dividend yield, that's why dividends matter. That CAGR, that performance, without the dividends, this company would be trash, would be very smelly, disgusting, and hairy. But because of the dividends, it turns into something that's kind of beautiful, an outperformer. You can see that there's violent swings depending on the market cycle, right? Sometimes it goes up as high as like, I don't know, right here would be about $60 a share, and then it drops, it goes up, it drops. It's almost predictable. It's not a smooth and steady ship that goes up and to the right like a Lockheed Martin. If we go all the way back to 1995, they were $26 a share, and surely in due time, they kept going up and to the right. Obviously, there were some corrections during market-wide catastrophic events like the Great Financial Recession in 2009, and obviously during the pandemic, they also got sold off, but over time, they recovered and they keep going up in valuation for their share price. But that is just not the case with OneMain Financial. And so when it comes to the cheese rating, are they delicious? Are they decent? Or are they moldy cheese? Like, do I actually want to own this business in my portfolio? Friends and family, I would say OneMain Financial falls under the B bucket. Considering their valuation of how it's at an all-time high and their upside potential, I think they're just decent, but on paper, they are an above average company. So when you blend the two, I think like a B minus or C plus would be more than fair for them. However, when I think about their business model, I'm not in love with them. So for me, I would pass. If I had to invest into a business that makes money from lending money, I would rather go with something like American Express or SoFi. Although they operate in an entirely different ballgame because they're not trying to target customers with a credit score of like 570. Then again, if you were to remove my bias, depending on who you are, OneMain Financial, it could be in the A tier because of their performance, right? Everything else, it boils down to the results and the output and the consequences. How do you perform as a stock, as an equity? It's an A. Right? But I feel like there's more factors to take into account. Please do keep in mind that I'm an idiot. All of this is wrong and inaccurate. So please do your own research and due diligence so that you can formulate an opinion on the company. Just because I made a dedicated deep dive video on the stock that was requested by a viewer like you, it does not mean that I endorse or recommend the stock. And other than that, quick life update so you guys know what's going on behind the scenes. I'm a first-time dad. Baby girl is 4.5 months old, and my wife's maternity leave ended a couple weeks ago, which means I've gone from helping out from time to time, like changing her diapers and bathing her, to basically running the full dad shift from about 5 a.m. to 4 p.m. when she comes home. So my bandwidth right now is pretty maxed out. So full transparency, the uploads on this channel, it may slow down slightly while I adjust to the new routine. And man to man, I really want to come across as an alpha and say, oh, it's easy raising a kid. Oh my gosh, anybody can do it. But that's just not the case. It's a different kind of challenge and a different difficulty. It's hard in its own way. Like, is it as hard as rucking with 85 pounds on your back for 25 miles? And a hit time of 4 hours and 30 minutes? Not in that sense, right? Physically, it's different. I think it's more so the patience aspect of it, like when she's puking or when I just changed her diaper and then she pees or poops and it just leaks out, it gets all over my clothes. Or when you're trying to feed her with the bottle and it's just not going smoothly, like the patience, right? She's a baby. I can't take out my frustration on her. I have to suck it up and just be nice, smile, and say, it's okay, soothe her, and try again. So it's different. So having said that, I appreciate you guys for sticking with me. I love you. Stay safe. Good luck in the stock market. And I will talk to you really soon. I need to take a nap.